You've probably noticed that some people seem to build wealth effortlessly through investing, while others lose money, make expensive mistakes, and give up completely. You might have even tried investing yourself and felt overwhelmed by the complexity, the thousands of options and all the conflicting advice screaming at you from every direction. You're afraid of losing your hard-earned money, you're not sure who to trust, and honestly, you're wondering if investing is even worth the stress. But here's what nobody tells you. Investing isn't actually complicated. There are literally 5 simple rules that if you follow them, will put you ahead of most investors and dramatically increase your chances of building real wealth over time. These aren't secret insider tricks or advanced strategies. They're basic principles that wealthy investors have been using for decades, but somehow they get buried under all the noise and hype. Today I'm going to break down these 5 rules in plain English, show you exactly why they work, and give you a framework you can use for the rest of your investing life. The first rule, and this might sound obvious but most people violate it constantly, is to start now and invest consistently over time. The biggest mistake beginners make is waiting for the perfect moment to start investing. They want to wait until they have more money saved up, or until they understand everything perfectly, or until the market drops so they can buy at a better price. But while they're waiting, they're losing the most valuable asset they have, which is time. Investing is not about timing the market, it's about time in the market. The longer your money is invested, the more time it has to grow through compound returns. Let me give you a concrete example. If you invest $5,000 at age 25 and just let it sit growing at 8% annually, by age 65, you'll have over $100,000 from that single $5,000 investment. But if you wait until age 35 to invest that same $5,000, you'll only end up with about $46,000. Same investment, but starting 10 years earlier more than doubles your result. That's the power of time. The consistency part is just as important as starting early. A lot of people invest once, put in a chunk of money, and then never add to it. Or they invest sporadically when they feel like they have extra money. But the smart strategy is to invest a set amount on a regular schedule, like every month or every paycheck, regardless of what the market is doing. This is called dollar cost averaging, and it's one of the most powerful wealth-building strategies available. Here's why it works. When you invest the same amount every month, you automatically buy more shares when prices are low and fewer shares when prices are high. You're not trying to time the market, you're just showing up consistently, and over time this averages out your purchase price and removes emotion from the equation. Most importantly, it builds a habit. You set up automatic investments, and it happens without you thinking about it. This consistency compounds over decades and turns small monthly investments into life-changing wealth. The second rule is to diversify your investments, which just means don't put all your eggs in one basket. This is probably the most repeated piece of investment advice, but people still mess it up because they don't really understand what diversification means. It's not just owning different stocks. Real diversification means spreading your money across different types of investments, different industries, and different geographic regions, so that if one thing fails, your entire portfolio doesn't crash. The easiest way for beginners to get proper diversification is through index funds. An index fund holds hundreds or thousands of stocks, all in one investment. When you buy a total stock market index fund, you own tiny pieces of essentially every publicly traded company in America. If one company goes bankrupt, it barely affects you because it's just one of thousands. If one sector struggles, the other sectors balance it out. Let me tell you why this matters with a real example. During the dot-com crash in the early 2000s, technology stocks got absolutely destroyed. If you had all your money in tech stocks, you lost most of your wealth. But if you owned a diversified index fund that included tech stocks, but also healthcare, consumer goods, energy, and all the other sectors, you took a hit, but you survived. And over time, your portfolio recovered and went on to new highs. Diversification doesn't prevent losses. The market still goes up and down, but it protects you from catastrophic losses that you can't recover from. It smooths out the ride and gives you a better chance of long-term success. The mistake beginners make is thinking they can pick the winning stocks or sectors and concentrate their money there. But even professional investors struggle to do this consistently. A smart move is to own everything through diversified index funds and capture the market's overall growth. The third rule is to keep your costs low, because fees and expenses will destroy your returns over time if you're not careful. A lot of beginners don't pay attention to fees because they seem small. You see a mutual fund that charges a 1% annual fee, and you think, 1%? That's nothing. But that 1% compounds against you every single year, and over decades, it can cost you hundreds of thousands of dollars. Let me show you the math. If you invest $100,000 and it grows at 8% annually for 30 years, you'd end up with about $1 million. But if you're paying 1% in fees every year, your actual return is only 7%, and you'd end up with about $760,000. That 1% fee cost you $240,000. That's not a small amount. That's real money that could have been your retirement fund or your kid's college education. This is why index funds are so powerful. They typically charge expense ratios of less than 0.1%, sometimes as low as 0.03%. Actively managed mutual funds often charge 1 to 2%. Over a lifetime of investing, choosing low-cost index funds over high-fee mutual funds could be worth literally $1 million or more. Every percentage point you pay in fees is a percentage point you're not earning in returns. So always check the expense ratio before you invest in any fund. Anything over 0.2% for a basic stock index fund is probably too high. Also watch out for trading commissions, although most major brokerages have eliminated these for stocks and ETFs. And avoid funds with sales loads or loads, which are basically commissions you pay just to buy the fund. There's no reason to pay those when there are thousands of excellent no-load funds available. The fourth rule is to stay invested through market downturns and resist the urge to panic sell. This is where most people fail at investing. They buy when the market is going up and everyone is excited, and then when the market crashes and everyone is panicking, they sell and lock in their losses. This is exactly backwards, but it's human nature. We're wired to avoid pain and seek safety. So when our account balance drops 20 or 30%, our instinct is to sell everything and stop the bleeding. But this is the worst possible time to sell because you're guaranteeing a loss and you're getting out right before the recovery. Let me give you some perspective. Since the stock market began, there have been dozens of crashes, recessions, and bear markets. The market has dropped 20% or more many times. But if you zoom out and look at the long-term chart, the overall trend is up and to the right. Every single crash has eventually recovered, and the market has gone on to reach new highs. The people who built wealth through investing are the ones who stayed invested during the scary times. In fact, the best investors often buy more when the market crashes because stocks are on sale. Think about it this way. If your favorite store had a 50% off sale, you'd be excited to buy stuff at half price. But when the stock market drops 50%, putting stocks on sale, most people panic and refuse to buy. That's emotional decision-making overriding logic. Now, I'm not saying market crashes don't hurt. Watching your account balance drop is genuinely painful. But if you're investing for long-term goals that are 10, 20, or 30 years away, short-term drops are completely irrelevant. What matters is where the market is decades from now, not where it is next month. The key to staying invested during downturns is having the right mindset and the right time horizon. If you're investing money you might need next year, the stock market is not the right place for it because there's too much short-term volatility. But if you're investing for retirement that's decades away, you can ride out the storms because you have time to recover. The fifth and final rule is to avoid trying to beat the market and instead aim to match it. This goes against what a lot of people think investing is about. Most beginners believe the goal is to find stocks that will skyrocket, to time the market perfectly, to outsmart other investors, and earn massive returns. But the reality is that trying to beat the market is incredibly difficult. And most people who try end up doing worse than if they had just invested in a simple index fund and held it. Study after study has shown that over 10 or 20-year periods, something like 80 to 90% of professional fund managers fail to beat the S&P 500 index. These are people with teams of analysts, sophisticated algorithms, and decades of experience. And they still can't consistently beat the market. What makes you think you'll be able to do it as a beginner working from your laptop? The smart strategy is to stop trying to beat the market and instead just capture the markets. Returns by investing in index funds. If the S&P 500 returns 8% this year, you return 8%. You're not trying to get 12 or 15% by picking hot stocks. You're just matching the market, which over long periods has historically provided excellent returns. This might sound boring and unexciting, and it is. But boring and consistent is what builds wealth. The people trying to beat the market, picking individual stocks, trading frequently, and chasing the latest hot investment are the ones who typically underperform and lose money. There's a famous saying in investing that goes, "Don't just do something, stand there." It means that often the best action is no action. Buy a diversified portfolio of index funds, hold them forever, and resist the temptation to constantly tinker and try to outsmart the market. Let me tie all 5 of these rules together with a practical example. Imagine you're 25 years old and you decide to follow these rules. You start investing immediately instead of waiting. You set up automatic contributions of $500 per month to a low-cost total stock market index fund, which gives you instant diversification across thousands of companies. You keep your costs low by choosing a fund with a 0.04% expense ratio. When the market crashes in year 5 and your portfolio drops 30%, you don't panic and sell. You stay invested and keep contributing your $500 every month, which means you're buying more shares at lower prices. You resist the urge to pick individual stocks or try to time the market. You just consistently invest in the same index fund and let it grow. If you do this for 40 years until you're 65, investing $500 a month at an average return of 8%, you'll end up with about $1.7 million. You invested a total of $240,000 of your own money over those 40 years. It grew to $1.7 million. That extra $1.5 million is compound growth and market returns doing the work for you. You did it by following 5 simple rules. You didn't need to be a genius. You didn't need insider information. You didn't need to get lucky picking stocks. You just needed discipline and patience. Now let me contrast that with someone who violates these rules. They wait until they're 30 to start investing because they wanted to save more money first. They buy high-fee, actively managed funds because the marketing materials promise to beat the market. They invest sporadically only when they feel like they have extra money. When the market crashes, they panic and sell, locking in their losses. They constantly try to pick winning stocks and time the market, buying when things are hot and selling when they're down. This person probably ends up with a fraction of the wealth of the person who followed the rules, despite maybe even investing more money total. The difference isn't intelligence or luck. It's following proven principles versus making emotional, inconsistent decisions. Before we wrap up, I need to remind you that everything I've shared in this video is for educational purposes only and not financial advice. I'm not a licensed financial advisor, and your personal situation is unique. You should do your own research and consider consulting with professionals before making investment decisions. My goal is to give you a framework and principles that have been proven to work, not to tell you exactly what to do with your money. So let's recap these 5 rules one more time because they're really that important. Rule 1. Start now and invest consistently over time. Don't wait for the perfect moment and don't invest sporadically. Set up automatic monthly investments and let time and compound growth work for you. Rule 2. Diversify your investments across many companies, sectors, and asset types. The easiest way to do this is through low-cost index funds. Rule 3. Keep your costs low by avoiding high-fee funds and unnecessary expenses. Every dollar you save in fees is a dollar that compounds in your favor. Rule 4. Stay invested through market downturns and resist panic selling. Short-term drops are normal and irrelevant if you're investing for the long term. Rule 5. Stop trying to beat the market and instead aim to match it through simple index fund investing. Boring and consistent beats exciting and unpredictable. If you follow these 5 rules, you won't get rich overnight, and you won't have exciting stories about the stock you picked that tripled in a week. But you'll build real, lasting wealth over time. You'll sleep well at night knowing your money is working for you in a smart, proven way. These rules have worked for millions of investors over decades, and they'll work for you, too, if you have the discipline to follow them. If this video gave you clarity on how to actually invest successfully, and you feel more confident about your investing strategy, I'd really appreciate it if you hit the like button. And if you want to keep learning about smart investing, building wealth, and achieving financial freedom without all the hype and complexity, subscribe to the channel. In the next video, I'm going to show you exactly how to build a simple investment portfolio using these 5 rules, step by step, so you can start putting this into action. Thanks so much for watching, and I'll see you in the next one.